Ladies and gentlemen, gold just lost more than a fifth of its value in a matter of months, and it happened for a reason almost nobody watching the headlines actually understood in the moment. If you own gold or silver, or you were thinking about buying either one, what happened over the past few weeks should change how you think about safe havens for the rest of your investing life. Because the popular explanation that one sentence from Donald Trump crashed the gold market is not wrong. Exactly, but it is incomplete in a way that will cost you money if you don't understand the deeper mechanism underneath it. Stay with me for the next few minutes, because by the end of this video, you are going to understand something about how markets actually work that most retail investors never learn, and it applies far beyond gold. Before we go further, I want to know something. Comment below and tell me where in the world you're watching this from, and tell me honestly whether you're currently holding gold, silver, or sitting mostly in cash right now. I ask because the answer tells a story. It tells us something about how ordinary people all over the planet are responding to a year that has been unusually frightening for anyone paying attention to their savings. Let's start with what actually happened, stripped of the noise. Through the back half of 2025 and into January of 2026, gold did something it had not done in generations. It went from being a quiet, almost forgotten corner of the investment world to the best performing major asset on earth, climbing to a record high above $5, $500 an ounce. Silver did something even more dramatic, nearly quadrupling from its lows to touch levels above $120 an ounce, a price that stunned even veteran commodities traders. Central banks around the world had spent years quietly accumulating gold, diversifying away from a reliance on any single reserve currency, and retail investors eventually caught on, piling into the metal as a hedge against everything from inflation to war, to a general sense that financial system itself felt less stable than it used to. And then through the spring and into the summer of 2026, that entire trade began to unwind. Gold fell from its January peak by close to 30%, breaking below the psychologically important $4,000 level for the first time in the year. Silver's collapse was even more violent, giving back nearly half of its value from the January high. And the proximate trigger, again and again, was the same: statements from President Trump regarding the conflict with Iran. When Trump threatened to escalate strikes, gold fell. When he declared an interim agreement with Iran over, gold fell again, losing $80 an ounce within 2 hours on that day alone. When his administration installed a new, more hawkish Federal Reserve Chair in Kevin Warsh, gold fell once more. Here's where most financial commentary stops. It reports the headline, shows you the chart, and moves on. But if you actually want to protect your wealth, you need to understand why a single politician's words could move a market that is supposed to be one of the most stable, most liquid, most globally diversified assets on the planet. And the answer is not really about Trump at all. Trump is the messenger. The mechanism is something much older, much more structural, and much more important for you to understand. Let's talk about how gold actually works as an asset, because this is where almost everyone gets confused. Gold pays you nothing. It has no yield, no dividend, no coupon. If you own a share of a company or a government bond, or even keep your money in a savings account, that asset generates a return simply by existing. Gold does not. The only return gold offers is the change in its price. Plus, in some cases, the psychological comfort of holding something tangible during moments of fear. The single fact that gold is a non-yielding asset is the key that unlocks almost everything else in this story. When interest rates rise or eye to rise, every asset that competes with gold for a place in your portfolio suddenly becomes more attractive. A government bond that once paid you almost nothing might now pay you 4, 5, 6% a year, guaranteed by the state. Cash in a savings account starts earning something. Suddenly, the opportunity cost of holding gold, the return you are giving up by choosing a metal that sits in a vault instead of an asset that pays you, becomes real and painful. This is what economists call the real yield relationship, and it is one of the most reliable patterns in all of finance. When real yields, meaning interest rates adjusted for inflation, move higher, gold tends to move lower. When real yields fall, gold tends to rise. It is not a perfect relationship, but over long stretches of history, it holds remarkably well. Now, overlay the Iran conflict onto this framework, and the entire puzzle resolves itself. When Trump escalated military threats against Iran, and when fighting disrupted shipping through the Strait of Hormuz, oil prices surged. Rising oil prices are not just a headline about gas station costs. They are one of the most direct channels through which inflation enters an economy, because energy costs ripple through the price of nearly everything else that gets produced, shipped, and sold. So as oil spiked, inflation expectations rose with it. And when investors and central bankers start to believe inflation will stay elevated for longer, they price in higher interest rates to compensate. That is exactly what happened. Betting markets that track the odds of Federal Reserve rate decisions swung sharply toward expecting hikes rather than cuts. And the odds of a near-term rate cut collapsed from around 1 in 4 down to roughly 1 in 8 in a matter of days. This is the paradox that confused so many investors this year, and it is worth sitting with for a moment because understanding it will change the way you think about crises for the rest of your life. Geopolitical conflict is supposed to be gold's best friend. Fear is supposed to drive people towards safe havens, but this year the same conflict that should have pushed investors toward gold instead pushed them toward the very thing that punishes gold the most: higher interest rates and a stronger dollar. The war did not fail to create fear. It created plenty of fear, but it routed that fear through the oil market and the inflation outlook rather than directly into precious metals. And the result was a mechanism working almost in reverse of what textbook safe haven logic would predict. There is a second piece to this puzzle, and it is the US dollar. Gold is priced in dollars globally, which means the strength or weakness of the dollar itself has a mechanical effect on gold's price separate from anything happening with interest rates. When the dollar strengthens against other major currencies, it takes fewer dollars to represent the same underlying value, which tends to push the dollar price of gold down. Through this period, as traders bet that the Iran conflict would keep energy costs and inflation elevated for longer, and as a more hawkish Federal Reserve chair took the helm, the dollar index climbed to some of its strongest levels of the year. So gold faced a genuine double blow. Rising real yields made it less attractive on a relative basis, and a strengthening dollar made it mechanically more expensive in local currency terms for buyers outside the United States, dampening demand from some of the world's largest gold-consuming nations. I want to pause here and talk about something that rarely gets discussed in financial content, but which I think is essential to understanding moments like this one, and that is the biology of how your brain processes financial fear and greed, because it explains why so many investors get these moments exactly backwards. When markets move sharply, whether up or down, your brain does not process that information the way it processes a calm, rational spreadsheet. Sharp price moves activate the amygdala, the part of your brain responsible for detecting threats, and this happens faster than your conscious analytical mind can intervene. This is a survival mechanism that served humans well for hundreds of thousands of years when the threat was a predator in the grass. It serves you very poorly when the threat is a red candle on a trading chart. Alongside this threat response, your brain's reward circuitry, driven largely by dopamine, reacts powerfully to the anticipation of gains and the pain of losses. Research in behavioral finance, building on the work of psychologists like Daniel Kahneman and Amos Tversky, has consistently shown that the pain of losing money registers more intensely in the brain than the pleasure of gaining an equivalent amount. This is called loss aversion, and it means that when gold started falling in the spring of 2026, the emotional pressure to sell was for many investors neurologically stronger than the emotional pull that had brought them into gold in the first place during the euphoria of January. This is precisely why so many retail investors buy near the top and sell near the bottom again and again across every asset class in every era of market history. It is not because they are unintelligent. It is because their brains are doing exactly what evolution designed them to do, and that design is poorly suited to modern financial markets. Understanding this is not just interesting trivia. It is one of the most practical pieces of investment knowledge you can carry with you, because recognizing the biological pull toward panic selling or euphoric buying is the first step toward resisting it. Let me tell you about someone I'll call Daniel, a 44-year-old small business owner who, watching gold's relentless climb through the end of 2025, decided in January of 2026 to move nearly a third of his retirement savings into gold and silver right near the peak. He was not reckless. He had read about central bank buying, about dollarization, about the debt trajectory of the United States government, and every argument made sense to him. What he not account for was timing, and specifically, he did not account for how quickly sentiment can reverse once a crowded trade meets an unexpected shift in interest rate expectations. By July, watching his silver position down nearly 40% from where he bought it, the fear response took over and he sold, locking in a loss he did not need to lock in right, as many analysts were suggesting the medium-term structural case for gold remained intact. Daniel's story is a fictional composite, but it reflects a pattern that plays out in some form in nearly every commodity cycle in modern financial history. This is not a story about gold being a bad asset. It is a story about the danger of entering any asset at the peak of public euphoria without a plan for what you would do if the price moved against you. Now, compare that to someone I'll call Amara, a 31-year-old teacher who had been slowly accumulating a small position in physical gold for nearly 3 years before this rally even began, treating it the way a prudent investor treats insurance rather than the way a speculator treats a trade. When gold spiked in January, she did nothing. When it crashed through the summer, she also did nothing because her original reasoning for owning gold as a small permanent hedge against currency debasement and long-term uncertainty, representing perhaps 5 to 10% of her overall portfolio, had not changed simply because the price had moved. By the time this video was being made, her position was worth meaningfully less than its January peak, but still comfortably above where she originally bought it. And she felt no urge to sell because she had never been trying to time the top in the first place. Again, this is a fictional illustration, but it captures something real about the difference between owning an asset as a strategic long-term allocation versus chasing it as a momentum trade. There is a third story worth telling about a man I'll call Robert, 62 years old, approaching retirement, who had never owned any precious metals at all until he watched gold's collapse below $4,000. And remembering headlines from earlier in the year about record highs assumed the crash meant gold was now cheap and safe to buy. He put a meaningful sum in near what turned out to be a temporary bottom, only to watch it dip further as the Iran conflict continued to whipsaw sentiment. Robert's mistake was not that he bought gold, it was that he was reacting to a headline rather than to a framework. He did not understand why the price had fallen, so he had no way of judging whether the reasons for the fall had actually been resolved. This is precisely the trap that this video is trying to help you avoid. Now, before we go further into what this all means for the future, I want to ask you for something. If you're finding this useful, take a moment to like this video and subscribe to the channel, because we go deep into exactly this kind of macroeconomic reasoning every week. And I promise you the final insight in this video, the one that ties everything together, is worth staying for. It reframes not just what happened to gold, but how you should think about every future crisis you'll face as an investor. Let's widen the lens now, because gold's crash this year cannot be understood in isolation. It sits inside a much larger story about debt, monetary policy, and the long arc of financial history. And this is where the historical parallels become genuinely instructive rather than just decorative. Consider the 1970s, a decade that shares more in common with our current moment than almost any other period in modern financial history. Two major oil shocks in 1973 and again in 1979 sent energy prices soaring, which in turn drove inflation to levels that seem almost unimaginable by today's standards, with interest rates eventually pushed into the high teens by the Federal Reserve under Paul Volcker in order to break the back of that inflation. In the near term, during the sharpest phases of those oil shocks, higher rates and stronger dollar dynamics could create real headwinds for gold, not unlike what we've seen this year. But over the full arc of that decade, as investors gradually lost confidence in the ability of paper currencies to hold their value amid persistent inflation, gold became one of the standout performing assets of the era. The lesson is not that gold always rises during crises. The lesson is that gold performance depends enormously on which specific mechanism is dominant at any given moment: rate-driven headwind or the currency debasement inflation-driven tailwind. This year so far, the rate-driven headwind has been winning. That does not mean it wins forever. There's another parallel worth drawing to the years following the 2008 financial crisis, when central banks around the world embarked on unprecedented programs of quantitative easing, expanding their balance sheets and pushing interest rates towards zero in an effort to stabilize the financial system. During that period, as real yields fell, and as investors worried about the long-term consequences of so much newly created money, gold entered one of its great bull markets, eventually peaking in 2011. The pattern again comes back to the same core relationship. When real interest rates fall and the future value of paper currency looks uncertain, gold tends to shine. When real rates rise and currencies, particularly the dollar, strengthen, gold tends to struggle even amid geopolitical turmoil. This brings us to the debt cycle, a concept that deserves real attention because it shapes the entire backdrop against which this gold story is playing out. Governments around the world, and the United States in particular, have accumulated levels of debt relative to the size of their economies that are historically unusual outside of wartime. Servicing that debt becomes more expensive as interest rates rise, which creates a genuine tension at the heart of monetary policy. On one hand, a central bank may want to keep rates elevated to fight inflation. On the other hand, extremely high government debt loads create pressure over time to keep rates lower than inflation would otherwise justify, because the alternative is an unsustainable rise in the cost of servicing that debt. This tension between fighting inflation and managing debt sustainability is one of the great unresolved questions hanging over the global economy right now. And it is precisely the kind of long-term structural concern that has driven central banks worldwide to steadily accumulate gold reserves over the past several years, seeking to diversify away from an over-reliance on any single government's currency and debt obligations. This is the deeper structural case for gold that has not disappeared just because the price fell this year. Central bank buying, which had been one of the primary drivers of gold demand through 2024 and 2025, reflects a slower moving, more strategic form of demand than the retail flows that pile in and out based on headlines. When World Gold Council data showed a significant wave of selling from gold-backed exchange-traded funds during this recent downturn, with tens of tons of outflows in a single stretch, that was largely a reflection of shorter-term, more sentiment-driven capital exiting the trade. It does not necessarily tell us what the world's central banks, who tend to think in years and decades rather than days and weeks, are planning to do with their own reserves. So where does this leave us? I want to be careful here, because anyone who tells you they know exactly what to do next is not being honest with you. And part of being a responsible investor is accepting genuine uncertainty rather than pretending to have answers you don't have. What we can say based on the evidence and the economic logic we've walked through is this: gold's price in the near term remains highly sensitive to the path of the Iran conflict, to oil prices, and most importantly, to the trajectory of Federal Reserve policy under its new leadership. If inflation proves more persistent and rates stay higher for longer, gold could remain under pressure or even fall further, regardless of how much geopolitical tension exists in the background. If, on the other hand, the conflict de-escalates, oil prices ease, and the Federal Reserve eventually resumes cutting rates, the same mechanical relationship between real yields and gold that has weighed on the metal this year could just as easily reverse and become a tailwind. Some analysts, including strategists at major banks, have suggested could still reach new highs later this year if that combination of central bank buying, softer positioning, and eventual rate cuts materializes, though this remains a forecast, not a certainty. And forecasts of this kind have a long history of being wrong in both directions. Now, here is the insight I promised you, the one that ties this entire video together, and I want you to really sit with it, because I think it is more valuable than any specific price prediction I could offer you. The lesson of this year is not that gold failed as a safe haven, and it is not that Trump single-handedly crashed a market with a sentence. The lesson is that every asset, no matter how ancient, how trusted, or how deeply embedded in human history, is still governed by the mechanics of real interest rates, currency strength, and the flow of capital seeking its next best return. Gold did not stop being a long-term store of value this year. What changed was the relative attractiveness of the alternatives, driven by a specific identifiable chain of cause and effect. Geopolitical escalation, an oil shock, rising inflation expectations, a shift toward a more hawkish central bank, higher real yields, and a stronger dollar. Once you understand that chain, the crash stops looking mysterious or emotional, and it starts looking like the entirely logical, if painful, result of a market correctly repricing risk. This is not a conspiracy. It is not manipulation. It is the ordinary, if brutal, machinery of global capital markets doing exactly what it has always done, moving toward the highest available real return, wherever that happens to be at any given moment. And this is the insight that extends far beyond gold. Every time you see a sharp, confusing move in any market, the question you should be asking is not what happened, but why did capital decide this was the moment to move, and where did it go instead? That single habit of mind, cultivated patiently over years, will serve you better than any single prediction ever could, because predictions expire and frameworks endure. For you as a long-term investor, here is what this actually means in practical terms. If you believe in gold as part of a diversified portfolio, the evidence this year does not invalidate that thesis. The structural drivers, high government debt levels, central bank diversification away from any single reserve currency, and long-term uncertainty about the purchasing power of paper money have not gone away. What this year should teach you instead is about position sizing and expectations. An asset with no yield, whose price is this sensitive to shifting interest rate expectations, is not a place to put money you cannot afford to see fall by a third in a matter of months. It is, for most people, a modest allocation, a form of insurance against a specific kind of risk, rather than a concentrated bet meant to make you rich. And the biological lesson matters just as much as the economic one. The urge to buy after a euphoric rally and the urge to sell after a painful crash both come from the same ancient part of your brain that was never designed to evaluate a spot price chart. Recognizing that impulse and building a plan in advance that does not depend on your emotional state in the moment is one of the few genuine edges an individual investor can have over the market. As we close, I want to leave you with something more than analysis. This has been a difficult year for anyone holding precious metals. And if you are one of the people who bought near the top, I understand that the numbers on your screen right now do not feel good. But the history of markets, going back centuries, is a history of exactly this kind of volatility, followed again and again by periods of calm, of recovery, and of new information reshaping the picture entirely. The investors who tend to do well over a lifetime are rarely the ones who correctly predict every twist and every headline. They are the ones who understand the underlying mechanics well enough to avoid panicking at the bottom and avoid euphoria at the top, who size their position sensibly, who think in years rather than in days, and who treat every dramatic headline as an invitation to ask deeper questions rather than to act on impulse. Stay informed. Stay skeptical of anyone offering certainty in an uncertain world, including me. And above all, protect your capital by thinking clearly rather than reacting emotionally. That, more than any single trade or any single asset, is what actually preserves wealth across a lifetime.